Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Imagine your most financially conservative, frugal friend.
Oh, we all have one.
Right.
Huh?
The one who constantly lectures everyone about living within their means, saving for a rainy day, clipping coupons.
But that's Zhao, that friend.
Now imagine that very same friend turning around on a random Tuesday and taking out a $100 billion mortgage on a sprawling, completely unfinished mega mansion.
That would definitely raise some eyebrows.
Yeah, that whiplash you're feeling. That is exactly what is happening right now in the artificial intelligence sector. Today we're taking a deep dive into the staggering, almost gravity-defying amounts of capital flowing through the AI industry.
It really is unprecedented.
It is. And based on recent financial filings, we are going to dissect a massive new deal that was just announced on April 20th, 2026, between Amazon and the AI model creator, Anthropic. But, for you listening, this is not just a story about two tech behemoths trading zeros on a spreadsheet.
No, far from it. When we look at the mechanics of this specific agreement, it serves as a master blueprint, really, for where the tangible physical wealth is actually being concentrated in this current economic cycle.
Right, because the headlines are always about the software.
Exactly. The headlines focus on the flashy stuff, the chatbots, the generative video, but the real investment narrative, it's buried in the concrete, the copper wires, and, frankly, the debt markets.
Okay, so let's get the headline numbers on the table just to set the stage here. According to recent analysis of the deal structure, Amazon is immediately injecting $5 billion into Anthropic.
Huge number just on its own.
Right, but it doesn't stop there. The deal includes an option for Amazon to invest an additional $20 billion if Anthropic hits certain commercial milestones. So we are looking at a total potential new capital commitment of $25 billion. And remember, this is layered on top of Amazon's previous $8 billion investment in the company.
The sheer scale of that capital deployment it's historic.
Yeah.
However, the truly fascinating mechanism here isn't just the money going into Anthropic.
Oh, right.
It's the money flowing back out. In return for this massive influx of cash, Anthropic has committed to spending over $100 billion on Amazon Web Services.
Wow.
Which is commonly known as AWS over the next 10 years.
Okay, let's unpack this, because there is a glaring irony here that anyone following the tech sector over the last, say, 6 months is going to spot immediately.
Oh, I know exactly where you're going with this.
We are talking about Anthropic legally committing to spend $100 billion on server infrastructure, right?
Yes.
Yet, based on public statements just a few months ago, specifically around December 2025 and February 2026, Anthropic's own CEO, Dario Amodei, was arguably the loudest voice in the room criticizing this exact behavior.
He was very vocal about it.
He went on the record, warning that massive, unproven infrastructure spending was a catastrophic risk. He literally argued that if an AI company's growth projections are off by even a single year, making these kinds of irreversible computing purchases could bankrupt them.
Yeah, he was highly critical of the broader industry's capital expenditure strategy. He was warning against this, blind spending frenzy driven by hype rather than actual fundamentals.
Which makes this current pivot feel incredibly hypocritical for an everyday investor who's just trying to follow the logic.
Yeah.
It's like my frugal friend analogy earlier. It feels like they are throwing their own playbook right out the window.
It does appear completely contradictory on the surface. But what's fascinating here is how Anthropic defends this pivot, because it highlights a crucial shift in how these companies view their own financial footing now.
Okay, how are they spinning it?
Well, according to recent analysis, Anthropic is drawing a very distinct line in the sand. They argue they are no longer engaging in, quote, unproven spending based on the vague hope of eventually achieving artificial general intelligence. Instead, they classify this $100 billion commitment as demand-based capacity reservation.
Demand-based capacity reservation. Come on. That sounds like the kind of corporate jargon designed to make a terrifying amount of debt sound responsible.
It does sound like a mouthful, but they do have some compelling operational data to support the terminology.
Really? Like what?
Well, data shows that Anthropic recently crossed a $30 billion revenue run rate. Furthermore, their enterprise adoption has really accelerated. They now boast over 1,000 corporate clients who are paying them upwards of $1 million a year for their AI services.
Okay, hold on. I need to stop you right there and push back on that, especially for anyone listening who might be newer to corporate finance.
Sure.
A run rate isn't actual cash sitting in a bank vault. The simplest way to think about a run rate is looking at your own monthly paycheck, right? If you earn, say, $5,000 this month, and you optimistically assume absolutely nothing changes.
Which is a big assumption.
Exactly. You project that out for a full year and claim a $60,000 run rate. It's a snapshot of today's momentum multiplied forward. So Anthropic is essentially taking their current hot streak, projecting it out to $30 billion a year, and signing a 10-year, $100 billion contract based on that snapshot.
That's essentially the math, yes.
What happens if Google or OpenAI releases a vastly superior model next month, and all those lucrative corporate clients decide to switch providers?
And that right there is the multi-billion-dollar vulnerability inherent in their strategy. You have correctly identified the core risk in high-growth tech, which is the brutal time delay between capital expenditure and realized revenue.
Right, because the money goes out the door today.
Exactly. A run rate is merely a trajectory, but that AWS contract, that is a legally binding obligation. And when we look at the reality of their balance sheet, the tension becomes really obvious.
What do the actual numbers look like?
Based on recent financial filings, Anthropic has already spent over $100 billion on model training and cloud services to date. However, their cumulative revenue, so the actual tangible cash they have collected from customers over time, is only sitting around $50 billion.
Wait, really? So they're currently operating with a massive structural deficit. They're spending $2 for every $1 they bring in the door.
Precisely the issue. The window between spending $100 billion on raw computing power and eventually recouping that capital through software subscriptions is an incredibly perilous gap.
Yeah, that is terrifying.
So while Anthropic's leadership claims they are merely reserving capacity for guaranteed demand, the sheer scale of this physical commitment places them firmly in the exact danger zone their CEO previously warned the industry about.
That is wild. And, that brings up the physical reality of this situation, which I think is where the story gets really compelling for the average person.
Absolutely.
Because what exactly is Anthropic buying with all this money? When most of us hear artificial intelligence, we visualize lines of code, algorithms, digital interfaces on our phones. We think of software.
Right, something intangible.
But this $100 billion deal isn't about software at all, is it?
Not at all. It represents a fundamental transition from the digital realm into the hard physical world. What Anthropic is purchasing with that capital is raw, unadulterated power and hardware.
Like electricity.
Exactly. Data shows this specific Amazon agreement secures up to 5 gigawatts of computing capacity via AWS. And remarkably, about 1 gigawatt of that infrastructure is scheduled to come online this year alone.
Okay, to put a gigawatt into perspective for you listening, it helps to step away from tech terms and look at real-world utilities. 1 single gigawatt of electricity is roughly equivalent to the power output of a standard nuclear reactor.
It's massive.
It is enough energy to continuously power hundreds of thousands of average American homes.
Right.
And Anthropic just secured up to 5 gigawatts. They aren't just renting server racks in a basement. They're essentially leasing the equivalent of an entire regional power grid.
The scale of consumption is difficult to overstate, and it really highlights why the primary bottleneck in the artificial intelligence sector is no longer software engineering talent.
Right, it's not just about hiring the smartest coders anymore.
No, the competitive moat is now entirely physical. It is a ruthless supply chain battle to acquire the electricity, to run the data centers, the industrial liquid cooling systems, to keep those processors from literally melting down,
Whoa.
and the specialized semiconductor chips to perform the calculations. If a company does not lock down its physical energy supply today, it will simply lack the operational capacity to run its advanced software tomorrow.
Which makes Anthropic's strategy even more intriguing because they aren't placing all their bets on Amazon, are they?
No, they are spreading it out.
Yeah. According to recent analysis, they've also struck aggressive deals with Google and the semiconductor company Broadcom to secure an additional 3.5 gigawatts of capacity starting in 2027.
That's right.
So their flagship AI model, Claude, isn't just hosted on Amazon Web Services. It's running across Google Cloud and Microsoft Azure simultaneously.
It is a calculated and highly necessary survival tactic. By utilizing multiple cloud environments, they are engaging in complex risk distribution.
It makes me think of a savvy restaurant owner trying to build a food delivery empire in a major city.
Okay, how so?
Well, instead of building one massive centralized mega kitchen, they sign long-term leases on a dozen commercial kitchens scattered across different neighborhoods. They source their ingredients from different farms.
Oh, I see.
That way, if one kitchen loses power or one landlord abruptly doubles the rent, the overall business doesn't collapse. The meals still get delivered to the customer.
You have the right framework there, but the stakes here are astronomically higher because of the sunk costs involved.
Right.
If a data center goes offline, or if Amazon falls behind in developing the next generation of custom silicon chips, Anthropic is protected.
Because they have options.
Exactly. By securing power and custom hardware from Amazon, while simultaneously sourcing different types of chips from Google and Broadcom, Anthropic creates an operational insurance policy. They can seamlessly shift their computational workloads to whichever partner is currently offering the most efficient physical infrastructure.
So what does this all mean for the everyday investor listening right now? I mean, if you are looking at your 401k or your personal brokerage account and you see these tech titans locked in a spending war over power grids and custom chips, how do you navigate this landscape?
You follow the actual flow of capital, which means looking upstream. Smart money in the broader market is rapidly shifting its focus away from trying to pick the winner of the software race.
Like trying to guess if OpenAI or Anthropic is going to win.
Right, that's too risky. Instead, capital is rotating into what the financial sector calls the digital industrial.
This is the classic picks and shovels investment strategy. During the gold rush, the people who consistently built generational wealth weren't the prospectors desperately panning for gold in the rivers. It was the merchants selling them the pickaxes, the tents, and the durable denim jeans.
That principle applies perfectly here. If Anthropic and its rivals are forced to spend hundreds of billions of dollars just to stay in the game, the logical investment question becomes, who is cashing those checks?
Right, follow the money.
Recent data shows immense capital flowing into the companies providing the physical backbone of this boom. This includes semiconductor manufacturers, the commercial construction firms actually pouring the concrete for these massive data centers, the public power utilities generating the electricity, and the specialized manufacturers of fiber optic cables and high bandwidth memory storage. These underlying industries are generating massive, reliable cash flows today, entirely regardless of which specific AI model ultimately wins the software war.
That makes incredible sense.
Yeah.
But it also forces us to look closely at the companies on the other side of these mega deals, like Amazon. Because Amazon isn't just sitting back and collecting Anthropic's money. They are actively burning a fortune to build out all this physical infrastructure.
Oh, heavily.
Data shows Amazon is projecting a staggering $200 billion in capital expenditures in 2026 alone. If you are an Amazon shareholder, looking at that kind of outbound cash flow, shouldn't you be deeply concerned?
Wall Street was initially quite unnerved by those capital expenditure projections earlier in the year, actually.
I bet.
But this specific deal with Anthropic is exactly how Amazon's management defends that spending to their shareholders. By legally locking Anthropic into a $100 billion commitment over the next decade, Amazon proves they have guaranteed long-term buyers for the very infrastructure they are currently building.
Oh, so it operates as an internal ecosystem loop.
Exactly.
Amazon essentially hands Anthropic $25 billion, and Anthropic immediately turns around and feeds $100 billion back into Amazon's cloud and hardware divisions.
Precisely. And it validates Amazon's broader strategy. According to recent filings, Amazon's AWS AI services already boast a $15 billion run rate, and their custom-designed silicon chips have reached a $20 billion run rate.
Oh.
Amazon is essentially telling the market, yes, we are spending $200 billion to pave the new digital toll roads, but look at the fleet of massive, well-funded trucks we have already contracted to pay those tolls for the next 10 years.
That ecosystem makes sense on a corporate level, but let's take a step back and examine the sheer gravity of these numbers.
Sure.
Because when hundreds of billions of dollars are ricocheting in a tight loop between a handful of tech giants, it fundamentally stops being just a Silicon Valley tech story.
Oh, absolutely.
If this demand slows down, like the AI models hit a plateau and this massive bubble deflates, who else is caught in the blast radius?
Well, if we connect this to the bigger picture, the systemic risks are profoundly concerning. According to recent analysis, global investments in data center infrastructure between 2025 and 2028 are projected to hit $2.9 trillion.
Trillion, with a T.
Yes, trillion. And the critical vulnerability lies in how that expansion is being funded. A massive $900 billion of that total is being sourced through private credit and asset-backed securities.
Okay, let's break those terms down because they sound very abstract.
Yeah.
What does private credit and asset-backed securities actually mean for the average person's retirement account?
It means the risk has migrated away from just venture capitalists in California.
Right.
Private credit often involves massive pools of capital managed by insurance companies, university endowments, and pension funds. Asset-backed securities are essentially complex financial products where loans, in this case, loans taken out by developers to build these massive data centers, are bundled together and sold to major Wall Street banks and institutional investors.
So you have a situation where, like, a municipal firefighters pension fund in Ohio might be quietly holding the debt for a 5-gigawatt AI data center out in the desert.
That is exactly the mechanism. Now imagine a scenario where the AI software growth narrative falters. Anthropic's projected $30 billion run rate drops because corporate clients cancel their subscriptions.
Because a better model came out, or it's just too expensive.
Right. So Anthropic suddenly cannot afford the massive cloud computing bills they committed to. In response, Amazon and Google immediately halt their infrastructure expansion.
The dominoes start falling.
Exactly. Suddenly, the commercial developers who borrowed billions to build these half-finished data centers cannot find tenants, and they default on their massive loans.
And because those loans were bundled into asset-backed securities and sold to pension funds, the default cascades right into the broader financial system.
The shockwave would be devastating. It would immediately strike commercial real estate markets. It would crash power utility valuations since their projected industrial demand would just vanish. And it would force major banks to write down billions in bad debt.
It's all connected.
We are no longer discussing an isolated technology trend. We are analyzing a highly leveraged, real-world infrastructure cycle that is inextricably tied to the health of the broader global economy.
Because they are consuming the equivalent of regional power grids, and their debt is entangled with national pension funds, these companies are no longer just software vendors.
No, they're not.
They have effectively become critical national infrastructure.
Yeah.
And, the moment a private company becomes critical national infrastructure, the government forcefully steps into the room.
Yes, the geopolitical and regulatory landscapes are rapidly becoming the most unpredictable variables for investors in this space right now.
So let's look at the legal risks first. Based on recent reports, Anthropic is aggressively expanding its footprint into Europe, specifically targeting highly regulated sectors like the banking industry.
Right?
Now, securing massive European banks as clients sounds like a fantastic way to boost that revenue run rate,
Right.
but it triggers an avalanche of compliance risks.
It does. And why does banking fundamentally alter their risk profile? Because under stringent financial regulations, European authorities treat the AI software vendor as an extension of the bank itself.
Oh, wow.
Yeah. If an AI model hallucinates a reason to deny a consumer loan or mistakenly processes a fraudulent transaction, the regulators do not view it as a harmless software bug. They view it as a systemic banking failure, and they levy catastrophic financial penalties accordingly.
And the domestic government risks here in the U.S. are just as tangible. Data from court documents released back in March showed that a potential Pentagon blacklist could cost Anthropic billions of dollars in future revenue.
Yes, the defense sector is huge.
And it's important to understand how that mechanism works for you listening. The defense sector isn't just one single client. Being blacklisted by the Pentagon effectively freezes a company out of the entire allied contractor ecosystem.
Right, the ripple effect.
You lose the military contracts? Sure. But you also lose the aerospace companies, the defense manufacturers, and the massive logistics firms that require federal security clearances to operate.
It completely cuts off a massive artery of enterprise revenue.
Now, we did get a very recent update on this front. On April 21st, President Trump stated publicly that Anthropic is, quote, shaping up, which strongly signals a potential normalization of relations between the company and the defense sector.
That's a significant shift.
It is. Now, to be absolutely clear, we do not take any political sides on this show. We analyze the market strictly through an objective economic lens.
Of course.
But purely from an investment standpoint, this event highlights an undeniable new reality. An AI company's financial valuation is now deeply and unavoidably tied to its relationship with the federal government and the defense sector.
It represents a complete paradigm shift for tech investing. 2 years ago, the market evaluated AI companies based purely on the technical capabilities of their models.
Right. Could the chatbot pass the medical board exams? Could it write clean computer code?
Exactly. But today, institutional investors are asking entirely different questions.
Like,
is their data governance compliant with the European AI Act? Are they structurally aligned with Pentagon security protocols? Do they have the political leverage to secure zoning permits for a new nuclear-powered data center?
It really reframes how we should view that $25 billion Amazon deal, doesn't it?
It really does.
It is not simply a wager on Anthropic's software superiority. It is a massive, highly leveraged bet that Anthropic can successfully navigate a brutal obstacle course of overloaded power grids, trillion-dollar debt markets, and complex global politics.
Yep.
So, to wrap all of this up, the core takeaway here for you listening is that the artificial intelligence boom has fundamentally matured. The era of cute chatbot parlor tricks is over.
Long gone.
We are now witnessing a heavily capitalized physical battle over who controls the electricity, who manufactures the underlying hardware, and who manages the colossal financial instruments backing it all up. Market premiums, the real rewards on Wall Street, are no longer flowing to the companies making the loudest promises about the future. They are flowing to the companies that have a clear, mathematically sound path to surviving the physical bottlenecks of today.
And that actually leaves us with a final, somewhat unsettling thought to ponder moving forward.
Yeah.
We have spent this entire discussion focusing on the massive scale of the physical infrastructure being built. The 5 gigawatt facilities and the trillion-dollar data center investments.
Yeah.
But what happens if the AI models actually succeed in optimizing their own architecture?
Wait, what do you mean?
Right now, we are pouring concrete for massive, energy-hungry computer chips. But if an advanced AI figures out how to rewrite its own underlying code to run the exact same computations on a fraction of the power,
Oh, wow.
the massive data centers being built today might become entirely unnecessary.
So the infrastructure boom could bust itself.
Exactly. The greatest risk to these trillion-dollar infrastructure investments might not be a slowing economy. It might be the AI simply becoming too efficient, turning today's most expensive physical assets into obsolete paperweights in just a few short years.
That is a phenomenal point. The technology might outpace the very concrete being poured to support it. We started out by talking about looking past the shiny new paint and going down into the basement to check the plumbing.
Right.
And I think it's clear that in the current landscape of AI investing, the plumbing is where the multi-billion-dollar fortunes are being made and potentially lost. Don't forget to subscribe and hit that like button.